Good afternoon, and thank you everyone for attending today's webinar. It's great to see so many of you taking the time to learn more about our trust, Natgen Investment Trust PG26. Our presentation today will run for about 25 minutes, and there'll be time for questions at the end. As we go along, you'll see down the bottom of your screen there's a Q&A button. You can start putting your questions in there, and we'll make sure all of those get answered for you. This afternoon, you'll be hearing from our Managing Director, Stephen Gokes, our Head of Funds Management, Peter Tills, and our Head of Acquisitions, Lachlan Pappas. With all our presentations, they're general in nature, and you do need to speak to your trusted advisor to ensure that this investment is suitable for you. It is available to wholesale investors only, and so you do need your accountant to verify your status for us. So I'll hand over now to Stephen, who'll start taking you through a bit more about NatGen and this trust in particular. Thanks, Stephen.
Thanks, Caroline, and thank you everyone for joining us today. Um, NatGen, as you know, I'm the managing director of NatGen, and NatGen is a commercial property investment company, and basically we're an ASIC licensed entity to provide you with solutions for commercial property investment across both investment and development in commercial property. Because we've got a fair bit to talk about today with regard to the actual property and location, I'm not going to tell you too much about NatGen. Probably the best place to find that is in the information memorandum, which you already have, and also in the Your Partner in Commercial Property Investment booklet, which you can see there on your screen at the moment. So that's available on our website or via the QR code that's on the screen as well. But just in general terms, um, again, I won't run through everything to do with NatGen, but as you can see, we run 18 active funds, might be a little bit more now, and we have assets across a series of areas of commercial property, including retail, medical, office, light industrial. Our storage is mainly to do with our development business and also some specialist assets as well. So I'll just move through that pretty quickly. So NatGen investments are either in NatGen investment trusts, which are where we purchase existing assets, hold them and manage them for unit holders for a period of approximately 5 to 6 years, typically. And the main thrust of a NatGen investment trust, such as PG26, is regular distributions of income monthly. We have the regular monthly income is the main thing that our unit holders in those trusts are looking for. Of course, we do have other potentials for capital gains and tax advantages in that. I'll mention that again in a minute. Then our NatGen development trusts fall into the short-term trusts where we basically develop something and sell parts of it or all of it, and the unit holders benefit through that process. Or our longer-term trusts are where we develop a property and then hold it to produce income over a longer period, and they're sort of more of a 6 to 8 year commitment. But keeping moving forward, the important thing about returns from a NatGen investment trust are there's that cash distribution, as I mentioned. All properties, all commercial properties, and all properties in general, really, have taxation benefits that accrue to them. And with our trust structure, those benefits pass directly through to unit holders. So you'll find that whatever the cash distribution is, it will have a percentage of that distribution comes with tax deferrals. So you don't pay tax on part of that distribution. That relates to the depreciation benefits that come from properties over time, and also some amortization that's possible through borrowing costs, and also some of the setup fees for the trust. And then crucially, a third aspect of commercial property is the potential for capital appreciation over time. Commercial properties are pretty much valued based on the capitalization of the income streams on the property, um, and thus a growing income stream from a given property will, in time, lead to appropriate capital appreciation. Important to note that you'll find that we never provide IRR calculations, or promising any IRR in particular with our trusts, unlike some of our competitors. The reason for that is an IRR is basically a number that's made up based on your cash distributions, and then um, basically a number that they consider is likely to be the end value of a property. Um, that is that is just something that none of us can really know with specificity. So it's always going to be based on an estimate. So we prefer to tell you what we know we can give you, and capital appreciation is something that is going to be calculated in the future. Um, so, and if they give you an IRR, it's naturally a bigger number than the cash income distribution return, and thus that's why people do it to basically be able to produce a bigger number up front, I guess. Um, Moving on, one of the benefits of commercial property in a portfolio is the uh, the nature of the income. Income is very solid in the long term on commercial property. This this chart shows basically the whole of Australia's commercial property assets, which are watched by the MSCI, which is a research group. And you'll see there in the purple, even through the vicissitudes of the global financial crisis, the previous downtimes that we've had, and even through COVID, um, when capital prices have gone up and down, really income has always been stable through with commercial property. And that's one of the advantages we see in a long-term portfolio sense for commercial property. Moving right along. Yeah, so when you're looking at what we produce for investment, we're always looking for commercial assets of with good tenants in excellent locations where we see some mispricing of that asset. If we can buy something for a better rate than we anticipate that it should be at that time, we'll certainly look at it. But the areas that we look at, particularly over time, and for those who've been around us for some time, you'll have heard us talk about this pretty relentlessly. Regional convenience retail is something we've always liked since the COVID years. Non-CBD office assets are a place that we see value in certain markets at certain times. Industrial assets is something that we've looked at for a long time and wanted to participate in, but in fact, this PG26 is the first asset we've ever found that have the attributes that we can put to the market. Um, Specialist assets, including medical centres and some other types, of things that we're constantly looking for good value in, and sometimes find that. And of course, development has a very different set of parameters, and is attractive to different types of unit holders as well. But particularly, we also look at why particular properties are going to have value in the long term. And that's really about where people want to be and while they'll continue to want to be in those places. So even when, for example, offices were a bit out of fashion because people were working from home and et cetera, um, it was clear that that movement had gone too far, and thus the office stock around the country and in fact around the world had had then dropped in value by too much because people were going to have to come back to offices. It's a sort of sociological and business need that people work together. So and that's actually what has come to pass. So that's why we look at sociological factors as well. Um, Now, what's happening in Queensland over the next decade or so is pretty exciting for us who are living through it. Um, we're calling it Queensland's infrastructure decade because there's massive amounts of expenditure coming through on major projects in Queensland over this decade. uh, culminating perhaps in the Olympics, but also beyond there. Um, so it's not all about the Olympics. This is not a one-story state at this stage. There's also um, massive population growth, which we're seeing across the eastern seaboard of the country, but certainly that in Brisbane as well. And also, transport infrastructure is growing massively because of that issue. And really, all those things that you see at the bottom of that top chart in the blue, transport infrastructure, utilities, and all that, that's just about keeping the current population well serviced. And then we've got extra types of industries adding extra to the infrastructure spend here. Um, I'll keep moving reasonably quickly. But this is something I went to a presentation with at CBRE in the middle of last year, and population growth has been massive in Australia. We've got somewhere between 1.5 and 2 million um, net migration over the last 5 years. So there's a lot more Australians than there were when we were all wearing masks. Um, but interestingly, CBRE research has come up with this metric that for every million of population that you increase, we need these basic things. So you need 420,000 new residences, be they units or houses. And as you're aware, we're falling way behind that requirement. Office space, 800,000 square meters of extra office space for 1 million people. So you can pretty much double these numbers for what we actually need. Retail, so basically the office stock has grown very little in that 5 years, whereas our requirement's probably closer to 1.5 million square meters. Um, Retail, again, over that time has grown very little. And again, we've got that sort of 1.5 million odd square meters required. Um, and logistics, crucially, is talking about 9 million square meters of extra logistics space. Now, that has been added to some extent, but nowhere near that sort of number. So all this means that existing properties, the incumbency of existing income producing properties is becoming massive. And I don't think we've actually seen the valuations reflect how important existing assets are compared to new assets. And particularly the other thing to consider in that sense is the uh, rate of increase in construction costs over the last 5 years, which no doubt you're aware has been um, unprecedentedly high. And also, we're looking at future um, construction cost escalation, looking at least 5% per annum over the next 5 years. So basically, in 5 years' time, it will be at least 25 to 30% and probably more expensive to build something than it is to build it today. And that again gives real value to the incumbency of existing shopping centres, existing industrial facilities, existing office buildings, etc. Um, so that's one of the reasons why I think it's a very exciting time to be both doing my job and also investing in commercial property. Um, so we get on to PG26. Uh, it's in, well, as you can read there, I'll move through this because I want to talk about some other stuff. We look at things like the lease structure, the quality of the asset, um, the area that the asset's located to make sure it's in an area that we feel is going to maintain its buoyancy or its economic relevancy. Um, we look at the industries involved, both in the property and surrounding. And as a part of that, we also make sure that there's a skilled workforce to actually maintain the momentum of that type of industry in that place. So we check all these things. Um, this probably pretty much says the same thing on this one. The target distribution we've calculated to be 8.24% per annum in the first year, and moving forwards, that should grow modestly over time. Um, Low vacancy precinct is also an important thing, and also constrained supply is something where we see value in the existing assets yet again, which is what we're always looking for. So why Mackay? Some people have said to me during this capital raising, "Oh, Mackay's just a little country town." Well, that used to be true, but now it's not. Um, One thing also about Queensland that uh, needs to be understood is the decentralisation of Queensland. Most Australian states are quite centralised around their capital city region, whereas Queensland has a much more decentralised nature in terms of where the economic activity is. Obviously, coastally based mainly, but there's four or five centres up the Queensland coast that impact that substantially. So some of the interesting facts about um, the new Mackay in the last 25 years-ish, since mining has become important there. The unemployment rates are very, very low, about half the Queensland average, which probably makes it about half the national average. And also there on the right, you'll see that um, the GRP per capita for Mackay, and which comes out also in incomes, is significant, over 20% higher than Queensland average. So the three big contributors to the area economically are resources itself, pulling stuff out of the ground and shipping it out through the ports. Mining equipment, technology, and services is also a massive area for Mackay. And having visited a few times in the last couple of years, I've been very impressed to see how much Mackay does in terms of technology and innovation in those markets, both for the local area, but also globally, really. And then agriculture has also been a major player in this part of the world for a long time. So just to situate us a little bit, we've got Paget is down there to the southwest of Mackay, but there's two major ports in Mackay. There's the port to the north of the Pioneer River, um, just above where it says Mackay CBD there, and then of course Hay Point, which is a massive coal terminal, and most of the exports from coal happen out through there with the integrated rail network and all sorts of infrastructure, particularly for that purpose. But also, it's not all mining there. There's a significant services sector. As I mentioned, there's the port facilities also service the agricultural industry with sugar and other ancillary commodities. Um, so there's a lot going on in this part of the world, and this next slide might give you a good indication of why. You can see there Mackay. You've got Bowen and Airlie Beach to the north, Rockhampton to the south, but the Bowen Basin and the Galilee Basin are right there, and these are the big coal export areas. Um, so when we look at this, and coal is a very important part of both the area and our tenant, uh, we've done a deep dive into the coal industry to seek to understand what's happening within the coal industry and what's the future looking like. I mean, if you read the paper too often, you'd see how coal's a sunset industry and yeah, all this sort of stuff, and we're replacing coal-fired power stations with other types of energy. All that is true, but one of the issues with the Bowen Basin and Queensland coal in general is it's predominantly and up to sort of 80% is metallurgical coal. And one thing before I started this I wasn't aware of is I thought coal was pulled out of the ground and burnt, and that's what you did with coal. Bad for the environment, but cheap energy. In fact, metallurgical coal's main use globally is to create steel, and coal is basically the carbon component in high strength steel. So basically, when baking the cake of steel, you need iron ore, I guess, refined iron ore, and heat and coal. You can't really make it in quantity any other way. So coal has a long tail of production requirements for any part of the world that needs steel, which is basically every developed part of the world. So, what have we done to prove this to ourselves? There's many reports have been issued on the coal industry, some by government, some by I guess you'd call them interest groups on both sides of the equation. Uh, so we've gone through those and looked to understand how the coal industry is likely to go forward, and the conclusion that comes from these reports is at least a 35 to 40 year um, time frame before the coal industry starts to subside in this part of the world, particularly for the metallurgical coal. Um, so getting on to Paget itself, it's a land constrained area of high use heavy industry. Um, as you can see, the Mackay Airport's just nearby, but really it's about the concentration of the assets in this sort of area. Um, if you look a bit further back, I don't really have a slide of it, but you'll see that there's a fair bit of greenfield around it. Um, but Importantly about that, that a lot of the greenfield around it is flood affected land. So it is basically constrained by this area having an appropriate level above the flood, the Bruce Highway on one side, and basically the city to the north. So it is supply constrained in that sense. Um, the offer, as you would have seen in our information memorandum, is we're raising $9.75 million to purchase this property for 15.1 million. The difference between those two figures comes from debt, and also we hold some cash for um, basically a just a capital account. We have to pay stamp duty for the purchase of the property and some fees in that as well. So the 50% debt will be taken on this property. We've got current, maybe Peter will tell you a bit about this later. We've got current offers from most of the major banks, which fall within our parameters on our calculations for what we need. Um, the tenant. The other thing that in our due diligence we look at carefully is the tenant. So in terms of these guys, we've done a deep dive into them through checking um, their credit worthiness, I guess you'd say mainly, and we came up with the fact that they are very well uh, when you get them a report from them, it reads very well. So, in particular, the collation of creditor data indicates that the company is in the low risk category, and the investigations we've done show no ATO defaults, no credit defaults, no court actions, and no mercantile inquiries on them. So, they're certainly clean. Although they're a proprietary local company, very clean. And the low risk category in the reporting that we've received indicates that they've got, and I'll quote from the report, strong credit quality based on behavioral and business demographics. Likelihood of default or insolvency is considered very low. Um, they're not required to lodge accounts with ASIC. So that's why we rely on the sort of creditor database to a fair bit. And this relates to data from the inception of the company in 2008. We've also conducted some limited due diligence on the directors, ensuring they're not on any public insolvency registers or anything like that as well. So I'll just keep moving on a bit. Oh, I beg your pardon. I didn't mention what they do. They build and service dragline large buckets for mines, and also the trays for those massive trucks that you see rolling through open cut and underground mines. So it's a fairly specific skill set that they have with, and it's servicing the mines within that western area. I won't go too much through the buildings, other to say that they're high specification and actually massively big. The photos really don't do it justice to see how big and strong these buildings are, and that's due to the fact that they've got massive cranes internally. There's 80-ton and 40-ton overhead cranes through these buildings, which, as you can imagine, requires very substantial structural integrity within the buildings. Last thing from me, I just wanted to make a comment about interest rates because we do have that 50% gearing. It's very topical this week, of course, but where our debt is not in this case and never is linked to the RBA official cash rate. It's linked to market rates, and we particularly look at the 3-year rates uh, within the market. Basically, the short-term cash rates are mirroring the RBA to a great extent at the moment. Um, but as you can see, the 3-year rates have already ticked up a little bit less than 1% over the last few months. So we're relying on that rate, and we've come up with our trust um, interest rate on borrowings on that basis. So we take that as our baseline, is what we can deliver, which as you can see, our trust term rate we've set as 5.7%. So that's made up of the green bar on the left, and then the margin that we are given by banks. So the banks basically compete for our debt by lowering that margin as much as possible. And the margins we're looking at the moment are sort of in the 1.4 to the 1.5 sort of area. So that gives us some confidence that we'll be able to fix our rates within the parameters here of 5.7. But if we don't, how does that work? If our interest rate ends up being higher than anticipated, the sensitivity analysis there can show that if interest rates higher, annual cash returns lower, and vice versa. So that's pretty much how that works. But we're very confident at this stage of being able to fix um, at our stated rate of 5.7%. I think that's pretty much all I had to say in particular, and I'm encouraging and looking forward to some questions a little bit later. But I'll now hand back to Caroline just to talk about how to invest.
Sure. Thank you, Stephen. So, all of you on the call would have received a copy of the information memorandum. You do need to consider that document in full. Speak to your advisor about how that relates to you personally. And if you're looking to invest, the first thing you need to ensure you understand is what entity you're going to invest in. You can use your self-managed super fund, maybe your family unit trust, personal names, or a corporate entity. To submit an application, you do that via the investor portal on the Natgen website in the top right-hand corner. It will take you through what you need to complete in there and upload things such as your wholesale certificate, identification, and copies of trust deeds if relevant. We might move on to the questions now. The first one around interest rates, I'll just read out the exact question that's been asked, and maybe Peter, you can just add anything that you thought Stephen mightn't have said.
Sure.
With the actual cash rate that just happened this week, uh, will it adjust the numbers in the document immediately in our information memorandum, or have we already locked in rates, and if so, for what period?
Thanks, Caroline. The quick answer is no, it won't change numbers straight away. As Stephen said, we've been looking at that. We always look at that 3-year rate because it sort of covers the average rate over that period of time. And as you could see on that chart on that previous page, that had spiked when we were just sort of looking at this property and going through due diligence. So we factored that in then. That rate actually probably covers 2 to 3 interest rate hikes. So yes, we've already got one interest rate hike under our belt. I note that some economists are calling May for another one, and others are saying we should be right to the end of the year. So, you know, it could be whatever out of all of that. But the main point is our numbers are based on something that's already counting 2 to 3 interest rate hikes already. What happens in reality is markets bounce around because we might get unemployment might spike and then, interest rates, then they think they might have to cut interest rates and all these sorts of things. And we try and take advantage of those market movements. So back on if I go back to that chart just for context, whoop, there we go. In that sort of March to October region, we actually did fix interest rates for some of our other trusts in that period to take advantage of that volatility. And you can see that the RBA cash rate was dropping, but it actually stacked up for those particular trusts to lock in those interest rates because it was under our IM forecasts, etc. So this is something we actively look, and no, we won't be changing anything in the IM as per the IM forecast at this stage.
Thank you, Peter. With regard to the valuation, we state that we looked for properties that are mispriced. What was the independent valuation outcome, if you can disclose, and are there comparable sales that are used? Did you want to
You want
answer
me
that
to
one,
take this
Stephen?
one away,
Yeah.
Caroline, or
Yes, thanks, Lockie.
Stephen? Okay. Quite simply, yes, we have undertaken evaluation, and yes, it does stack up in with where our purchase price is. We use these valuations as independent third-party reference points. They're by no means the basis of our underwriting. Valuers work off the available market evidence, and in tight precincts such as Paget, there is the comparable data sets for true heavy industrial accommodation is naturally quite thin. A lot of stock is owner-occupied and doesn't trade or lease frequently. So we don't outsource the entirety of the investment case to the valuation. Our underwriting is grounded mostly in tenant demand, scarcity of comparable facilities, lease structures, and the operational utility of the asset. I'll hand it back to you now. But no, quite simply, the valuation is an important external check for us. But the core thesis stands on the market fundamentals and the difficulty of replacing these kinds of assets.
Thanks,
If I could
Lockie.
just make one extra observation about that, Caroline. Sorry, it's Stephen
Sure,
here.
of course.
Is in the valuation that we've received is at our purchase price. I've been doing this for over 30 years, and I've never found a valuer who's ever given a valuation above the purchase price once they know what it is. So we're never looking for anything above purchase price, but valuations typically have three ways of valuing, and this is the case. In this case, they look for comparable sales and comparable evidence. They do a discounted cash flow on the future cash flow expected from the asset, and then they just do one on a general capitalization approach too, based on what all assets have in terms of capital value as a percentage of their their current rental. So this is no different. It's happened exactly the same way. Thanks, Karen.
Thanks, Stephen. Our last question, will there be further properties purchased in PG 26, or is this a single property investment? I'm happy to answer that one. It is what you see is what you get. It's the only asset in the trust, and no other properties will be added into it. You might see on our website we do have another trust that's got 2 assets in it, but at the time of the investors choosing to go into that particular trust, they knew exactly where the assets were, what they were, and that has remained the same through the life of that trust as well. I think we've just got one more question. If the tenant left, are there similar businesses that would seek this business? I'll seek this building, sorry. Did you want to take that one, Lockie?
Yes, of course. Look, Paget, being what it is, look, vacancy is always possible, but Paget is Mackay's core and heavy industrial precinct, and high-spec facilities like this don't come up very often. And look, when they do, they don't remain empty for long. The building is specialised enough to be pertinently valuable to occupiers. It houses cranes, heavy slab, hard stand, and importantly, great access as well, but still broadly relevant to mining services, engineering, fabrication, and a lot of infrastructure users in that precinct also. And because comparable stock is simply tightly held and difficult to replace, there's a strong releasing and occupier-led backstop if that was the case.
Thank you. That's great. Well, if no one else had anything else to add, that's the last of the questions that have come through. We'll finish up there, and all of us presenting today are available at any time on our 1300 number or via email if you've got anything else you'd like to discuss after considering the offer. So thank you very much for your time today. Thanks, everyone.